I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Strategic Officer at T3Live.com.
And I'm Brittany Umar, and together we bring you Morning Call. So most world markets are off a bit after the tremendous move that we've seen in September. Futures for us, though, are pretty quiet as the Fed begins its 2-day meeting today. Yesterday, we did see markets gap up on news that Larry Summers was bowing out of the race to be the next head of the Fed. But the move lacked real power and real follow-through, I guess is the better term, Scott. So would you say that's cautionary for us?
I would say it's just a little bit frustrating. I think so many cute little terms came out like the gap and nap, the gap and trap, because for most of 2013 it seems like a lot of these gaps happen, but then they failed to produce much follow through throughout the course of the day. So what do traders have to do? They actually have to carry positions. And we've been in probably 3 different trends for the course of this year, and lots of times, you know, the trend is a bit easy. You follow the 8 and 21 day, you could hold 8 to 12 positions or whatever it is that makes you feel comfortable and ride it out until it changes. This most recent move off the lows happened pretty fast and happened, you know, I think almost out of left field, so to speak, because so many people were cautionary. So with yesterday's big gap up, like we saw yesterday, back at old 2013 highs, or some actually sectors were through it, made sense that we didn't have so much power, but again, you know, it just goes to show you that the intraday action, you know, it has been frustrating for, you know, active traders that don't take much risk.
Well, why don't you give us a visual then as you're walking us through those levels?
Okay, well, if you go back to the chart of the SPX, which we've shown many times, here is that trend. Here is the trend starting in November, okay, which has held in very tight for all of this year. We did have a test right here in June. You guys remember that outside day in May. You remember when this accelerated trend, which is one of the trends that a lot of guys were following, that, you know, you took some risk off when it failed here, or perhaps when it failed on this breakout failure. You know, and then you fast forward to where we are now. Okay, we had this, you know, little head and shoulders top that gave us a 4.5% or so correction, held the trend line. Here was a spot to, you know, put some risk back on or cover shorts. Here was another good tactical spot. So, you know, look how fast this happened in September when everyone was expecting for this to break. So with that said, we had a gap up, stalled here in front of the old highs. Look how extended we are from the 8, 21, and 50 day. So this gap that happened on September 10th never got filled. We digested it. Now we have to measure to see what type of action we have to see if this gap, you know, holds and digests, or do we, you know, come back and create an area here that I think would be better to do for then new highs, you know, later in the fall, or, you know, coming close to Thanksgiving.
Well, markets do tend to focus on rates and gold ahead of the Fed. And yesterday we talked about how we saw a pullback in rates and how that could present a buying opportunity in the TBT, because we've talked a lot about that 2013 theme of going long the TBT. And it looks like that was a buying opportunity.
Yeah, for active guys that came in without a position in it, they said, okay, you know, it's maybe a little emotional that, you know, Summers bows out. You know, rates are not, or should still continue to rise, so it's an opportunity. So for those who have been trying to navigate it, which is not the easiest to navigate, that's always say put them in the draw, especially if a 6 to 18 month plan, because rates should be higher. But if you did have the luxury of buying the dip yesterday, look at the chart. You know, it made some sense. Tactically, you know, you've had a few different moves here. This trade really started to get much better when it gapped above this prior resistance. Okay, this is what started the year, started the trend, and then it's been holding the 21-day moving average for the majority of the time. Yesterday, you take a closer look, you know, it gapped down and then engulfed, you know, this entire little area, so that shows you short-term, you know, bullishness on this situation. You know, we talked about if it gets to the 50-day, it could be an opportunity like we saw in August. It was, you know, it held even higher. So with this wedge type pattern building up here and this consolidation, I do think it's only a matter of time to resolve to the upside. So if you want to keep it in the drawer, keep it in the drawer. You want to trade it, I do think we get some trade above that within time. And if you look at the TLTs, you look at this downtrend, lots of guys have made some nice money shorting this the whole way down. This is a different way to play rates rising, and right now it still looks like it's trapped in this downtrend. Big engulfing day yesterday. So with some time, this probably takes out this 102 area to the downside. So if you're looking for opportunities there sometimes ahead of the Fed, you get the quick movement if you don't just keep this type of thesis in the drawer.
What about gold? We are seeing gold bounce back ahead of the Fed. Do you think the move that we're seeing there is likely to be sustained?
I think gold is just a bit oversold, so it could bounce a little bit here. I think some would have thought yesterday on that news it would bounce better, but it didn't. You look at the chart here, gold itself has been really behaving very well technically, I might say. If you have opinions in gold, you might think differently. Lots of people thought that this overall range and this uptrend would resolve to the upside. It didn't. You could have made a little decision point of 160, another one at 159, another one here, and then remember that blood on the street lows that we talked about right there? That was a nice, red dog reversal right there. Then it trended all the way into resistance and then got a little wishy-washy. So here was that reversal, 2 days ago, and then yesterday got met with a close in the low, and now it's gapping up $1 or so. So this is why I think short-term guys don't like to trade gold. It's so random. You would have thought with the close in the lows yesterday with no upside on that news, it would have continued, but now it's opening up. So some shorts are trapped and some longs are like, oh my goodness, I got out yesterday. So here's your pivot. This pivot is 128. If it were to stay above 128, maybe it tries to fill this gap and retest this trend line that was broken, in earlier September. But overall, gold is very random. You have to really pick and choose your spots carefully if you want to be involved.
Well, in our continuous search for relative strength, the banks held up well yesterday. They did not fade as much as the rest of the market, and Goldman Sachs was actually able to tack on another 1.8%, so pretty impressive there.
Yeah, a lot of things, faded off the highs, and this one kind of held in there. So I'm going to continue to have the banks on the radar, especially going to the Fed. You look at Goldman Sachs. I do think at some point it should make new 2013 highs. I thought maybe yesterday could have been the day. It wasn't. Here is that gap up from 5 sessions or so ago. Still looks good. I would say for this to stay intact, I'd like to see it hold 165, go a little sideways, and then try and make another move at some point. Maybe it'll be after or after the Fed speaks, because that's typically when some moves do happen.
And Morgan Stanley, meanwhile, was able to see new highs yesterday.
Yes, and this one, that for the first half of the year was one of the weaker banks, turned into one of the stronger ones, and that just shows you how you have to switch gears and look where the relative strength is. And this over the summer gained some relative strength. You look at the chart here, pretty healthy that it actually already made 2013 highs. You saw Goldman didn't. This one did. Okay, it actually made a new high right here prior. Okay, so with that new high, it then digested above it, and then yesterday you didn't get much follow through to the gap, but if you've been holding it since this breaking of the descending channel here, you don't have that much to worry about, and at this point I think it still looks good. So if you're holding it, stay the course.
And JP Morgan, not one of the leaders in this group, but was able to close back above the 100-day yesterday.
Yes, and this one I've been kind of avoiding because it feels like every other day they have a headline. And with that said, if you want to play a stock that's in the headlines, I'm sure at some point they're going to subside, and then it too could be at 2013 highs. But right now, if you look at the chart, you'll see there's been some relative weakness. Look where the summer highs are, and look where it is. So it's showing you that this one is not the place to be right now. So if you have time and you love JP Morgan, you know what, give it the time. But overall, I think this is your next little pivot here, right around 54. If it gets above 54, maybe it gets some momentum. But overall right now, there's news out there that the guys that were trying to hide the London whale trade are now, in trouble. I personally think, just to, put my little red dog thought in there, that, if you guys remember when this whole situation started back, it was almost in 2012, the summer, when Europe was imploding. I think what they did is they made big bets on Europe, and it was going against them a little further than they thought, so they didn't talk about it. They had a big trade go against them, and then somebody on the other side of the trade was getting scared, so they got the media involved, and then all of a sudden they had this huge loss that they had to cover because the media likes to do that to the banks. And PS, 2 months later, Europe bounced. 6 months later, had some follow through, and then we saw some of these indices make 5-year highs. So overall, that bad trade for JP Morgan could have been a huge winner, if the media didn't get involved, and probably would have blown up some hedge funds that were on the other side of the trade. I think that's the real story that nobody's looking into, not just putting pressure on the bank because it had a big loss. That trade was not putting JP Morgan out of business. It was just a bad trade that they, kept cost averaging into because of whatever.
And then got perpetuated even more in the headlines.
Yeah, and the headlines made them cover because too big to fail. Everyone's footsteps of what happened when all of a sudden all this was it's almost like they held Apple from 700 to 500 and right before the bounce. But that's a bad.
Unfortunately, a lot of people can probably relate to that.
Yes, exactly.
All right, well, let's just get in one more bank. Bank of America, we know this has been a favorite of yours in the past. It was able to tack on some small gains yesterday and close above all key moving averages. So looking pretty good.
It looks good, but I think even like me, I have in the back of my head, I think this Friday they get taken away from the Dow, so I'm not sure what has to come out of it and what the pressure is. So I do think, though, that will be an opportunity. That's why it's being held back. So you look here at Bank of America, you'll see the chart still looks good. Above the moving average. It's just not, making new highs before some of the other ones. Okay, it's still being controlled a little bit right here. The trend is still really strong, and it's holding above the moving averages. I think that this pattern is just building, and at some point, maybe after the Fed and after this whole little situation where it's taken out of the Dows out of the way, I think then it could take out this 1503. But for right now, just it feels like it's just in waiting mode, and if you can handle the volatility, keep accumulating above 14 for what could be new highs before the year's end.
Well, as money continues to rotate this year, we're seeing the solar group try to get back in play. We're going to go in the trenches with some potential setups in that group right after this quick commercial break.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF. I'm Mark Sperling.
We're back and going in the trenches with some potential setups in the solar group. A lot of these names look like they're trying to get back in play, and let's start with Elon Musk, Solar City. I know this is one of your favorites.
Well, I follow his names, and
right.
For me, that's pretty handicapped in the solar area because I just don't trade them well. I gravitate towards this one, and this one's given you, some nice opportunities since it came public. And there's been some times to be long, sometimes to be short, sometimes when it has a good setup. And right now, I like this setup to the long side. You look at the chart here. First things first. This was the tremendous run it had in April that peaked in May. You had a huge bull flag here that resolved to the downside right when it broke 45. That was kind of went off our A list. Resumed, held this trend line, tried to come back up and then broke it. So that was another spot to take some risk off here. And then, anytime you get a wide range bar like this that's so potent and engulfing, this whole range, you put it back on the map and then see if there's continuation. So you do have a bull flag type pattern right here. So with that being said, in order for it to really get going, it's going to have to start breaking above 36.93 to 37. And if it does and the solar group remains in focus, I think there is another additional trade here if you happen to miss this, this engulfing, igniting bar back on September 10th.
All right, and then there's JK Solar, which has been building up our level base above its 8 and 21 day. So is that a sign then that it's getting ready to possibly break out?
This one is closer to its highs than some of the other names. If you look here, some guys, I hear them talk and chirp about it. I particularly don't really focus on this name, but doesn't mean you can't. It is above the 8, above the 21 day. It looks like it tried to go yesterday, but reversed, which is a little bit of a cautionary sign. It looks like it happened twice. So some people might be losing some interest there or losing money trying to play a breakout. But anyway, I would say as long as it holds above the 21-day, which has been, you know, a roadmap for this thing since June, you know, stay with the trade. And, you know, if the whole group acts better, maybe they'll let a leader stock like this that's, you know, look, it's showing leadership, you know, break out. But for right now, you know, I still think it's just trying to build, and, you know, just don't have too much size here because these things are thin.
So that one just needs a little bit more time.
Yeah, expect, you know, if the group's going to go, this one looks, you know, technically somewhat best.
Okay, well, so how about Canadian Solar? Because this one's been basing above the 8-day for about the past 2 weeks.
Let's see. You know, there's another Canadian company that's not doing so well, which we won't talk about. But anyway, this one looks a little bit better. You go here and you'll see that, you know, to me, let's see, I haven't really brought this one up in a while. Like, I guess you could draw your trend right here that wound up breaking. Okay, this was an outside day to cap off what was a really nice trend above the 8-day. This is when it broke below the 8-day and 21-day, take some risk off, you know, came back in vogue. You know, it looks okay. You know, again, these solar names I have a hard time with. I think Mike Lee trades them pretty well, and Steve LeVay and those guys. You know, at this point, didn't have enough power to break above this area, so this is your momentum line, 1457. If it gets above 1457, maybe you get momentum. If not, you know, just you know, don't get too much size here because you can get stuck in these names.
And First Solar has been one of the laggards in this group, but it has been trying, it seems, to perk up for some time now. So
I like that word, trying. It's trying to shine.
True.
Red Dogism. Solar name. Here we go.
Redifor.
Redifor. Here's FSLR. Okay, this was, you know, in play on a lot of, you know, traders' radar for, you know, this spring time frame. Oh, I missed the spring. But here is your big, you know, igniting bar, which we like to see. This is when it held, went sideways and continued. Bit of an outside day right there. Bit of a break of a trend. You know, then here bounced back. Big gap down, still unfilled. It's somewhat in this lower range here, trying. You know, but it's still the trying is the word. Okay, if you want to be long some because you're a FSLR fan and you're trading it maybe versus 35, okay. If you're trading for a gap fill or momentum, it really has to get above this 40-40 with heavy volume in order to get me interested and get guys a little bit more excited.
All right, let's do some quick hits here and talk Apple. Another weekday for the stock yesterday, shed more than 3%. It seems as though the composure of this one has changed for now.
Yes, this composure changed on event day. You know, we talked about how, you know, for a year now, you basically have to love Apple and leave Apple, okay? Because every now and then you get a nice quick trend, but you have to monitor it closely to see if the trade changes. And after earnings, you had the gap up, you broke the downtrend. It was fun. We were high-fiving. We were able to hold Apple for a while, and then on event day, it changed. You go to the chart here, and you will see that here is, you know, this is when we were getting very, very excited about Apple right there. Remember, you know, here's your double bottom. Here's when it broke this downtrend line. You know, get going. Maybe we get back to 500 or so, and then boom, boom, boom. Look at this nice move. Okay, took back the 200-day. That's when Carl Icahn gave out his little tweety, and then boom, look what happened thereafter. So I know I was trying to be long, and I was thinking maybe we get a move above this area for healthy action if Tim Cook wasn't Tim Cook, but he's Tim Cook, and he didn't wow anybody, and what they came out with was very expected, and it broke below this 503.50, which you heard me talk about and tweet about. That was my, okay, this trade is no longer pent up. It's no longer riding a nice trend. Get out of the way, and you had to get out of the way. And then now look where it is. So if you got out of the way here, yes, it was disappointing. You saved yourself a really nice, you know, painful move to the downside. And then we talk about gaps. This gap, unfilled, usually leads, you know, to the same direction in the way of the gap, which was down. And now, you know, what do you know here? This is where it broke out from. You know, this is yesterday's low, 447. It's down a little bit. You know, if you sold here, you know, perhaps, or you sold somewhere in here, you could try a little bit today, but ultimately this trade to me looks very broken. It's at the 50% retracement, so I guess if you know, it could be an opportunity today, but I really doubt it's going to amount to much. So take what you can get here in Apple.
All right, well, Tesla was one of the first stocks to show relative strength yesterday, but closed on its lows, but it did manage to close above its 8-day. So is the fact that it closed on its lows not that concerning?
It's not that concerning, but you know, most people that trade Tesla like momentum, so when it starts off strong and ends a little weak, it's a little bit frustrating, but overall the trend is still strong, but you have to follow it closely because these type of stocks are priced for perfection. And when things change a little bit, if you're not committed to it, you have to notice it. It hasn't changed yet, but it's worthy of looking at. And you look at the chart here, you'll see, here's a trend, since it broke out in May. It's been above the 21-day, went below it for a day right here. Could have changed, didn't. And then every time it's been tight, go. Tight, go. And now, traders are basically looking to see if it can go again. So it couldn't yesterday. Maybe it just needs more time, but it's worthy of watching. You don't want to see it fail. You don't want to see a big close below the 21-day, because that'll mean that the momentum is waning, and you just have to be a bit more patient. So overall, still in here. We'll see how it goes. I was with it yesterday. I kind of got stopped out of it just because it didn't go, which is what guys wanted. So I'm giving it more time. Make sure you know where the 21-day is on this one, and it is 160.58.
All right, and lastly, let's just do a quick check-in on Facebook and the levels you're watching there.
Well, Facebook, a lot of people are on my side, the virtual trade floor. It's like, Red Dog, why aren't you talking about it? You've been out of it for a few days. And because it was a nice trade, and it's been a nice trade, it met the measured move of that cup and handle pattern, which was one reason to exit. Another reason to exit was finally last week, everyone got all euphoric on the Twitter IPO. Everyone started upgrading it, and then it reversed and closed in the lows. So to me, that means it needs a pause. And since I'm active, I can get in and get out. I could save myself some pain. And if you look at the chart here, not a lot of pain, but you know what? Entries and exits matter, and this was that gap up. So once it closed back below 45.09, I think I got out of that trade. And then what did it do? Just to measure something, to take your likes and dislikes out of this, here's the 8-day moving average. It closed below it for the first time in a while. So if you were able to sell here, this is a minor, complexion change, but not a lot. Now you'll see if it holds a 21-day. I do think if it gets down here, hopefully maybe even today, I will be looking to be a buyer because, if you sold 45-ish, you could buy sub 42 for, an opportunity, or you look for some type of Red Dog reversal. So the pivot for that is 42, 43. So maybe even it comes down, holds a 21-day, and reverses and creates that tail today. That would be very good for traders.
So in closing, what will you be focusing on, Scott, as we begin the trading session?
I just, with 2 days going into the Fed, yesterday you had that exciting gap up that had no momentum, so some people use that as a reason to sell. There are some bears calling a double top, but they've been going all in short probably since January 1, so at this point you don't know that yet. I don't think that's the case. And I'm going to just try and continue to put some trades together, stick with some situations if the trend changes, if there are small changes in situations like we saw in Apple and you had to get out of the way, or you saw a little bit earlier this week, on Facebook, just continue to know your time frame. Know that if you get out of something because it breaks the 8-day for the first time, you got to get back in it at some particular point if it gives you that entry, because if you get out of it and you look good for 3 days and you're a longer term investor and you'll get back in and then it makes new highs, it's very hard to get back. So I think at this point, markets, in my opinion, the highs aren't in, like the bears are all saying, but the next 2 days could be a little sloppy going into the Fed, and I don't typically like Fed days, especially when you have a major event around it, because then the computers will go a little nuts on you.
Right.
But overall, action's been pretty good. You don't have to be all in or all out, but there are situations working where you could have risk on, but not all in risk.
All right. Well, with that said, happy trading, everybody. Have a great day.